Okay, here's a common question that I usually get asked when people are refinancing, especially when they're doing a cash out refinance or they have some other financial goal in mind and they need to refinance. But I think it also bears, and I'll talk a little bit about this, consideration when you're actually getting your initial mortgage when you're buying a home. And that is, what's the right loan term or the number of years? And in this particular scenario, I'm only talking about fixed rate mortgages, which tends to be the most popular. It's not always necessarily the best for your situation. There's definitely a real advantage and reason to using an adjustable rate mortgage. But for the purposes of this discussion, we're going to be talking and assuming only fixed rate mortgages and the terms associated with those. So what is the right loan term for you? Most people just go into their mortgage, whether they're refinancing or whether they're actually getting their first home or buying a home, they just go in and assume 30-year fixed rate is what I want. And that doesn't always make the most sense. And it's certainly not always the most affordable mortgage in particular. So I want to go through a couple different scenarios where it might make sense to shorten the term of your mortgage. So as we talk about refinancing here, a lot of the common reasons that people will shorten the term of their loan. So they're looking to lower the rate potentially. Of course, this changes the payment. Doesn't necessarily go lower, but it will change the payment. So they're looking to lower the rate, often shorter terms, have better rates. Maybe they want to get rid of their mortgage insurance or get out of an FHA loan. The mortgage insurance, they could of course pay down under 20%, but if you have an FHA loan and you're starting to build up some equity in that loan, this has mortgage insurance for the life of the loan. So refinancing is really your only option to get rid of that mortgage insurance. And then, of course, potentially paying off your mortgage early. Of course, you can do this by just paying extra on the principal, but sometimes people, again, for other financial goals, or maybe they want to actually take some cash out in the process of refinancing, they will actually pick a shorter term so that even though they're doing that, they're going to go ahead and still pay that mortgage off. The other thing really important, especially if you're doing cash out refinance or you're refinancing for some other goals, you originally probably started with a 30-year fixed rate mortgage, and if you've been paying on that for 5 or 10 years, the worst thing you can probably do is to reset that to another 30 years, because it's just going to tack on that 5 or 10 years that you already kind of paid on that mortgage. You're just going to extend that payoff out another 30 years. So a lot of times people don't want to do that, and there's a lot of great products out there that will allow you to just match the term that you're at and do whatever you need to do as far as that refinancing, whatever goal you were trying to meet there, you can match that up. So if you've been paying on it for 10 years, you can take a 20-year loan out. But I also want to show you kind of the pros and cons of how that affects you dollar-wise when we get over here. Okay, so the top two questions, I always like to, whenever I'm doing these, I always like to talk about the questions that I'm asking my client to figure out if this is the right mortgage for them. So these are two popular questions that I ask. Can you afford the higher payment? So whenever you're shortening the term, almost invariably you're going to be raising your payment. There are certain kind of inflections in the market that happen at just the perfect time where you may actually be able to get a lower rate, or you may be able to somehow get very close to getting a similar payment with a shorter term, but those opportunities are few and far between. So generally I'm asking the client, and we're assessing together whether or not they can afford the higher payment of a shorter term. And then when I'm figuring out which term I'm looking at, 30, 20, 15, 10, or whatever along that spectrum, I want to know, where am I getting the biggest bang for my buck? Because sometimes shortening your term to a really short term isn't necessarily giving you a better advantage. Just like necessarily putting down more down payment doesn't always get you a better rate or a cheaper loan. It'll certainly make a reduced loan size, but you may not be getting the best bang out of your buck. And whenever I talk about getting the best bang for my buck, I'm talking about the lowest interest rate and the lowest cost of that loan over the life of the loan. So let's take a look at that. Let's go over here to this graph, and I've drawn this out, and if you read the article, you'll see kind of a more detailed schematic and table that actually shows the numbers and the math here. But I've kind of visualized it here. And so what I did here is, and this is something I used from my Quicken Loans days, we used to always talk about the diff. which is a really good way to figure out where you're getting kind of the best bang for your buck, is looking at the difference between the percentage of change between these different terms. So I'm looking at the percentage difference between the rate I would get here at 30, 20, 15, and 10, or the difference between the amount of interest I will pay over the life of the loan for 30, 20, 15, and 10. And when I graph that out, I see a really interesting thing. There is this inflection point where both of these curves are fairly steep up into a point of 15 years, and then both of them tend to flatten out. This one continues to go up, of course, because your interest paid over time, the term is still there, so you're going to still have some additional time to pay that out. So it tends to be a little bit steeper, but it definitely starts to flatten out as you go into these shorter terms. So what that tells me is when I go from 30 to 15 years, I get a real steep advantage. There's a significant difference between what I'll pay in interest rate and interest payments as a result. Obviously, the interest rate from a 30 to a 15 year is a significant difference. But after that 15 years, going to a 10 year really doesn't get me that much. That interest rate is going to be very close to what it is for the 15 years. This is also just the actual interest rate itself. The difference between a 30 and a 20 year is not really that significant, right? The interest rate between these, and in fact, if you look at the table in this article, what you'll see is the 30 and 20 year rates are kind of a little close together. And then when you move from that 20 to 15, there's a big jump. Between the 20 and 15, you get a real advantage, or you get a really a steep reduction in your interest rate when you move from that 20 to that 15. And then from 15 to 10, they're kind of like tightly spaced here again. So the 30 and 20 are about the same, the 15 and 10 are about the same. So if you're going to make a jump, you might as well go from a 30 to a 15, and you certainly don't need to go all the way to a 10, which is really going to increase that payment. So this inflection point, this 15 year, and a lot of you guys already know that I'm a big fan of Dave Ramsey, but he'll also tell you that the 15 year, and he's right on this, is generally, in most markets with most lenders, your 15-year mortgage is going to be your best rate and your cheapest or lowest amount of interest paid over the life of the loan. So when you're thinking about your term, again, we want to think about these two key questions. Can I afford what is probably going to be a higher interest payment? And then when I'm actually selecting the term on that spectrum, where do I get the biggest bang for my buck, which is the lowest interest rate, or the biggest difference in interest rate between the 30-year term and some subsequent shorter term, and where do I pay the least amount of loan cost and interest between the difference of that 30-year and whatever that subsequent term is. So these are some factors to consider if you're thinking about shortening the term of your loan.